Good morning. Welcome to Stock Market Today for Tuesday, March 31st, 2020. I am your host, Dan Russo, Chief Market Strategist at Shaken Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Shaken Analytics. Head over to shakenanalytics.com/today, where you can sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider. Hits your inbox every trading day before the market opens. So U.S. equities were higher in Monday's trading, closing near the best levels of the day. All sectors were higher, led by healthcare and tech. Treasuries were stronger across the curve. Dollar was stronger versus the euro and sterling, but weaker on the yen cross. Gold finished down 70 basis points. WTI crude down 6.6% after crossing below $20 a barrel. As we get to the desk this morning, futures are flat after extending that bounce yesterday. Asian markets were mostly higher overnight, with Taiwan, South Korea, and Hong Kong leading. European markets are seeing good gains. The treasuries are weaker, with the curve steepening. Dollar is stronger on the major crosses. Gold is down 1.1%. WTI crude is up 5.8% to get us going on the final day of the first quarter, which has felt like an eternity. Taking a look at the structure of the S&P 500 now, we are knocking on the door once again of the 38.2% retracement level. We've been highlighting this level for the past week or so as an initial level of interest on a rally attempt. Now, should we break through here, I think the door is open to the 28,900 level, but we're watching closely because on the way down, as I've said, we sliced through support like it didn't exist. And now if the market struggles at resistance, that to me tells you that the bears are in control. So 2350 as initial support on the downside. That's roughly the December 2018 lows. Below that, 2,021. Resistance, we're knocking on the door, as I said, near to the 2650 level. RSI is holding bearish ranges. There is that small divergence still at play. But really, for me, you're going to have to see a close above that 38.2% retracement to get me more excited. Shaken money flow is bullish. Has actually pulled back a little bit here over the past couple of days, but does remain bullish and above this downtrend line. So I think we're watching this level closely. I want to see a close above 38.2% to kind of change my view. We are still in the camp of last week's low, likely to be retested. The real question is, from what level will that retest begin? Turning now to our market in a minute. What are we writing about today? Well, rebound continues as SPY moves to that key retracement level. But what's interesting to me is that the defensive stocks led the rally off the lows. We'll take a look at that a little bit later on in the show, but you've heard me kind of reference it yesterday. We're watching the bearish divergence in tech on a relative basis. Healthcare is the only sector with a bullish power bar ratio. And as I said, futures do point to a flat open here today. Turning now to those power bars. The Dow adds 3% yesterday, 0 bulls, 7 bears. S&P 500 up 3.2%, 12 bulls to 143 bears. So a bit of an uptick there with this rally. NASDAQ up 3.65%, 7 to 23 bulls to bears. Small caps underperform in an ongoing trend of underperformance for small caps, up 2%, but lagging the S&P by over 1%. 73 to 473 bulls to bears. Bonds down, tick sending yields higher. Healthcare, one of our favorite groups, was up 4.7% yesterday, and as I said, only group with a bullish ratio, 6 to 1. According to the Chaikin Power Bar, small cap stocks and large cap stocks are strongly bearish. Major indexes are mixed to bearish. Let's hit our stock of the day now. Stock of the day is actually a stock that I'm highlighting in my note for clients today, and it's Eli Lilly. Eli Lilly has a bullish Chaikin Power Gauge rating, and we can see here if we drill down on the factor categories, financials are weak, but earnings and technicals are very bullish. Experts are also bullish. So when we take the 5 factors from each of these categories to get to the 20, we come out with that bullish rate. And we do have a strong trend above a ever so slightly rising long-term trend line. The industry group is weak as pharmaceuticals have a bearish power bar ratio. But as we look at the structure here, we can see the rating just turned bullish, and the stock's been an outperformer. It's outperforming the SPY since the beginning of December. Overbought, oversold indicator rounding out of an oversold condition while money flow is bullish. So if you are, potentially looking for ideas to put some money to work, this is the type of name where you want to take a look. I'd be more comfortable if we saw a close in the S&P above that 38.2% retracement level, but I realize that we want to kind of keep the idea flow coming. Lilly is certainly the type of name that we want to pay attention to should the market begin to stabilize, as that relative strength has held up through the market's downturn. Let's hit our sector tracker now. The movement of the major sectors over the last 5 days, and this is what I'm talking about when I say that the rally off the lows was defensive in nature. Take a look at the top of the list. Utilities, greatly outperforming the S&P 500 over the past 5 days of trading, as is real estate. Now, real estate's a bit of a bifurcation in terms of where do you want to be, right? I don't necessarily think it makes sense to be focused on anything levered to retail as well as assisted living at this stage of the game. However, real estate generally a defensive group, as are utilities. Rates have come in, so that's helped their picture, but that is a defensive rally. There's no two ways about it. And after that, it was kind of that beat down rebound, right, as you see industrials, energy, and financials towards the top of the list. Healthcare, materials, and tech are middle of the road. Discretionary, nice rebound here, but still an underperformer. Staples giving some back. Was one of the more surprising charts in my note today, as did comm services. So all groups are higher over the past 5 days, with your defensive bond proxies outperforming during the what is still, in my mind, a bear market bounce. Our industry in focus today, biotech services. 11 bulls to 42 bears. This group has actually outperformed over the past 6 months by about 12.66%. However, that ratio is bearish, as I said, 42 to 11 bears to bulls. But that does get it a rank of number 4 of 21 subsectors, having moved down 2 slots over the past week. So as we're parsing through the stocks, the names we want to avoid: Global Blood, GBT, Sarepta, SRPT, and Decifera, I may not be saying that properly, DCPH, all with very bearish ratings. But as always with biotechs, they all have their own kind of idiosyncratic story. You need to drill down and have a firm understanding of what that story is, in my opinion, if you are going to invest in individual biotech names. But let's take a look at the group here. XBI is the ETF that we're using to track the biotechs as a neutral plus Chaikin power gauge rating, but a weak trend below the declining long-term trend line. There's your ratio. 11 to 42 bulls to bears for a group that has been outperforming since mid to late November for the most part. Money flow is mixed. Let's call it neutral. It is outperforming. Overbought here in the near term, so I wouldn't be surprised to see some sort of a stabilization, maybe a pullback here as it tests the 21-day exponential moving average below the trend line. So, hard for me to get super excited from a trend perspective. I do like the outperformance. I do like the fact, though, that, if you're willing to do the work, the kind of the idiosyncratic nature of each of the stocks makes biotech somewhat immune to what's going on in the economy, not immune to the risk-on, risk-off preferences, though, of investors. Taking a look at what's trending now, yesterday's S&P 500 movers and shakers are gainers and losers. UHS reacting positively and following through on the back of stimulus announcements. Cigna up 10.5%. on the heels of positive sell-side comments. Autodesk, ADSK, nothing company specific to drive the trading in Autodesk yesterday, as that stock tacked on 10%. VIAC, sell-side analyst at Needham, actually lowered her numbers yesterday and lowered her price target, but the stock did rally 10%. So maybe investors kind of were expecting numbers cuts. I think at this point, investors are expecting the worst as it relates to earnings estimates. That being said, today is the final day of the quarter, so investors are going to start to turn their attention to earnings announcements, as bad as they might be, and in particular the forward guidance. In my view, it's not in management team's best interest to do anything but set an extremely, extremely low bar. MCK, we're starting to hear about PPE ramps. That sent that group higher yesterday. The drug and healthcare supply chain stocks having a positive day yesterday. MCK up 9.8%. On the loser side of the board, Royal Caribbean said they are extending some of their cancellation periods. I guess if you had previously booked a cruise and now no longer feel compelled to take it, They've extended their cancellation window. So that net, I think, is a positive from a human perspective, but not good for the stock, down 13%. American Airlines is giving back some of the rally that they saw last week. Carnival priced an offering tonight. Looks like they did an equity offering. Looks like there's also some fixed income products in there as well. Stock was down 11% yesterday. We'll see how investors react to the fact that they at least were able to raise cash. The terms, though, I don't have a clear picture on. Norwegian NCLH is extending some of their suspensions. So that stock is down 11%. And Kohl's KSS announcing further closures. That stock is a bearish stock, and it was down 8.66% yesterday as closing more stores. So let's talk about the structures here. It's Tuesday. That's relative strength day here at Chaikin Analytics. We like to get a sense for sector rotation, what's going on with the different sectors, where is leadership, where is emerging leadership. Tech remains leadership. There's no two ways about it. Okay, this is a solid uptrend for XLK relative to SPY. Somewhat extended from the 200-day moving average. Don't necessarily think I'd be chasing relative strength here, but the fact that it is relative strength is our one of our main focuses. Now, we do see this negative divergence. We called it out last week. We're calling it out again today because this new high in the ratio was met with a lower high for the RSI. So far, RSI is holding bullish ranges, but we want to be mindful of the divergence, which is why I would say we're not chasing strength on a relative basis in tech. On an absolute basis at the bottom of the chart, you can see the breakdown through the trend line now rallying back. We'll see how it reacts. Take a look at XLK. I think that $85 level is important. It's important for tech to get back above that $85 level if you're playing the ETFs. From a trading perspective, on a relative basis, we are watching that divergence if you're structuring portfolios from a more strategic perspective. Healthcare, on the other hand, is a group that we continue to like, right? I said earlier that healthcare was the only group with a bullish power bar ratio, and you can see it here. Nice rally to lead all sectors yesterday, up 4.71%, 6 bulls to 1 bear. We're looking at XLV relative to the SPY, and we can see, you know, a topside breakout above the 200-day moving average for the ratio. Now, the initial breakout and move higher produces an overbought condition that has now been worked off, and on the subsequent pullback, we hold 50, right? So the RSI for the relative is holding bullish ranges. So that's encouraging. Could see a bit more of a consolidation here, but we continue to like the healthcare sector on a relative basis. If we take a look at XLV on an absolute basis, right, in this case, a lot of the relative strength we're seeing just means down less than the overall market. You can see we took out support, went into that low last Monday, and now we've rallied back. So we want to kind of watch this support level at $95, which is now potentially a resistance level. So again, you want to watch how markets react now as they come to resistance, right? Was former support, does it become stronger resistance? That's kind of the theme that we want to see, while also being mindful that on the way down, support was broken fairly easily, especially at the index level. So continue to watch healthcare here. We like the group. It's the only group with the bullish power bar ratio. And then finally, I talked about the defensive nature of the rally, and you'd see it here pretty clearly. XLU relative to SPY, brief undercut of the 200-day moving average before rallying, right? This is relative. So it rallied last week more than the overall market. RSI is holding bullish ranges, right? And you can see here, here's the S&P 500, right? Into the rally low, into the low rather, and then a rally on a relative basis. The utilities outperform. So just something to keep in mind here as we knock on the door of the retracement level. That'll wrap us for a Tuesday, folks. Have a great day. Head over to ChaikinAnalytics.com/test drive. Sign up for that free 14-day trial. I'll be back with you tomorrow.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.